Hello everyone, my name's Phil. For some of you, I'm a fellow classmate from BUSI 3001, Accounting for Business Combinations. For others, I'm just a stranger who's explaining accounting for business combinations. Regardless, you're all welcome to stay and watch this video. Alright, so what I'm going to be going over today is I'm going over the ins and outs of the midterm. Since our prof John doesn't intend on going over this in our lectures, and I'm doing it for myself to also get a better understanding of the material. So I'm using this modified marking scheme without the marks included. I've also included 2 marks that he removed and how the questions would have played out had you chosen to get that mark, or had you gotten that mark, or if you didn't get it. So those are both included in this marking scheme. I also included a different color scheme. So blue is the question that we're on, red is the part of the question that we're on, and green is any associated background work to get the part of the question or the answer for the question. As we had discussed in our class on July 9th. So this marking scheme that I sort of modified, and the midterm itself are going to be in the description. So you could just hop on that and download it there. As well as if you'd like to jump to any specific part or question, you could just do that in the description as well. All right, let's get started on question number 1. So question number 1 of the midterm was creating the journal entries for an equity method investment from a parent to a sub. So recall that when we use the equity method to do dividends or net income, it's basically always the same. For a dividend, we debit cash and we credit investment in the sub. Now, the reason why we debit cash and credit investment, so when we credit the investment, it's going to be going down since the investment in the sub is an asset. The reason why we do that is because the sub paying out a dividend could be interpreted as an opportunity cost of receiving any future growth in the investment. So since the sub isn't now reinvesting their capital, this investment that the parent now holds is going to be decreased since they don't have that capital to reinvest. So that's the sort of rationale that I like to apply for that. And since the parent purchased the sub at 70%, we multiply the dividend value by 70%. So the dividend was 80, multiplied by 70%, we get 56 right here. Debit cash, credit investment in the sub. So that's also done down here in year 2, so we won't be covering that down there because it's basically the same thing. Now we're going to move on to net income. So when we receive a net income from a sub, we credit our investment income, and we debit investment in the sub. So assuming that they receive income, we could use that same rationale. Since they receive income, they'll have more capital to reinvest into their business practice, and it could offer future growth. So we received a $70 debit right there in the investment in the sub, and we could credit investment income right there because we could claim that as income on our income statement. So we take 70% of that since we're 70% owners, and there we go, we got that. And the same thing was done down here in year 2, although it's a little bit different in year 2 since we received a $10 loss right there. And when it's a loss, we simply flip that entry. Remember, equity and liabilities are on the other side of that fundamental equation, assets equal liabilities plus equity. So normally when we receive income or revenue, it should show up as a credit. Now it's showing up as a debit, so we're incurring a loss over here of $7 right there. Okay, and now we're going to move on to the gain on land. So since we own a 70% interest in the sub here, we can't claim all the profit that the sub gets by selling land to the parent. So to further elaborate here, what happened is that the sub sold the land to the parent at $50 over here. The land had a cost of $30, so the sub made a gain of $20. But the parent can't actually record that $20 because it's an intercompany transaction. So what we do here is we hold back the gain on the land since the parent holds land at this point. So we're not recording the portion of the gain that belongs to the parent. So the way we've done that is we recognize the gain, which is $20, pre-tax gain right here. And then what we do is we multiply it by the portion owned by the parent, which is 70%, and also the portion of tax. So the tax rate is 20%. We could multiply that by 80%. That gives us 16 times 70% gives us $11.2 right there. And so we want to hold that back. As we discussed, when income shows up as a debit right here, it shows up as a loss. But we're simply holding this back because we can't recognize that gain. And that could be recognized as soon as that land is sold outside of the parent-sub relationship. So we're going to move on to the entries in year 2 regarding the gain on land. So in year 2, the parent has now sold the land outside of the company. So they could actually record this gain, but first they're going to record it as follows on their books right here. So they just record that cash here. They sold it for $80. They credit the land because they no longer have it, and that's $50. And then they record the corresponding gain right here. As we discussed, income shows up as a credit because it's on the other side of that fundamental equation. Assets equal liabilities plus equity. And they got a gain of 30. But now we could record the gain that the sub had made on it, because now it's outside of the parent sub relationship. So we reverse that holdback gain on the land right here. So we can now claim that investment income of 11.2, and our investment in the sub will increase right there. So that's all it took for question number 1. We're now going to move on to question number 2. All right, so now we're going to be going over question number 2. So there's a little bit of a twist in question number 2 that caused the total marks to be dropped, to be reduced from 45 to 43. And I'll be going over one of those twists in this question, and then we'll be carrying on with the method that most people used. But you could always grab this Excel document right here and figure out how to get it with the twist. All right, so first we're going to do the goodwill calculation. So we bought 80%, and that costed the parent $400. But we got to figure out the implied value at 100%. So we simply divide 400 by 80%, or 0.8, and then we get 500. We need to subtract the carrying value of the sub's net assets now. I personally like to use shareholders' equity because there's less accounts and it's quicker to calculate, and that's 350. We subtract that from 500 and we get acquisition differential of 150. Now there's no fair value excess in this question. It's 0, so we just get our goodwill value at 150, which is nice because we don't have to make a goodwill and acquisition differential amortization table, and we could just skip that step because since we got our goodwill and there's no amortization. So now we're going to talk about intercompany transactions. There is an intercompany sale, unrealized profits in inventory, as well as intercompany balances. So first we're going to discuss intercompany sales. Simply enough, the sub sold to the parent goods that were $600. Now we're going to talk about inventories. So the sub sold, so in the opening balance for the year, the sub had sold $40 worth of inventory to the parent. And in the ending inventory, the sub had sold 120. Now, it's important to realize that since it is inventory, it is a current asset. And the assumption that we have with current assets is that it'll be eliminated off our books within a year. So, having said that, opening and ending inventory is going to be treated a little bit differently because opening inventory is assumed to be sold outside of our consolidated entity. So neither the sub nor the parent own these goods anymore. But in ending inventory, since it hasn't been a year, and ending inventory technically is this moment right now, the end of the year, then we can't record those profits. We're going to go through what's going on over here now. So we need to figure out what the profit or the gross margin is on this inventory. So In the previous year, they had provided us 30%, but it explicitly stated in the question that we had to use 30% for the previous year, but it didn't say anything about the current year. And if you extrapolate from the current year, you get 25%. You can see that right over here. And so profit and ending inventory. Basically, we take the 500 worth of gross margin, divide it by the 200 worth of sales, and then we get 25% of our gross margin. And like I said, you just extrapolate that from the income statement. So what we're going to do now is, since most people used 30%, we're going to carry on this problem using the gross margin of 30% right here. So that's simply the next tab over. All right, so we divide our amounts that the sub had sold by 30% to figure out what profit the sub had made on this inventory, or we're calling it gross margin here. And these are our pre-tax gains that the sub is making right here. And if we apply our tax rate of 20%, which was provided in the question, we get $2.4 and $7.2 for opening and ending balance respectively. And then we get 9.6 for opening balance and 28.8 for the ending balance as a post-tax gain. So important to remember about this, that that inventory is a current asset. We're going to be revisiting that idea in just a moment. So for intercompany balances, right over here, we have the parent has an accounts payable to the sub of $80. Now remember, if there's an account payable to the sub, that means that the sub is also going to have an accounts receivable. So it's sort of like a two-way street. If one is receiving, the other is paying. Now we're going to talk about part A, so the consolidated income statement. We're just going to leave the intercompany balance transactions right there. Excellent. All right, so just to start off, UG means unrealized gains, RG means realized gains, because these are mentioned in over here in costs of goods sold. So this summation sign also means that we're adding together the income statement or the balance sheet of the parent and the sub. So we're going to start off with sales. So we add together the income statement of the parent and the sub, and then we subtract the 600 of intercompany sales. So remember right here, the sub had sold to the parent $600 worth of goods. In costs of goods sold, we also subtract that, and I'll explain that in a moment, but we'll first talk about these inventory balances over here. So like I said, inventory is a current asset. And like I also explained, that a current asset is technically eliminated off our books within a year. That's the assumption. So if the sub makes a sale to the parent, a year after that, the parent should technically sell those assets outside of the consolidated entity, so the parent and sub relationship. So right here, this $12 right here, which is a realized gain, and that's why it is realized. So that's taken from right over here. So this $12 is subtracted from cost of goods sold, and if we're subtracting an amount from cost of goods sold, it's going to increase our profit. So they're realizing this inventory over here because it's increasing our gross profit. Now we're going to talk about the unrealized gain in ending inventory. So remember, since this is currently sitting in our inventory and it hasn't been more than a year, this is still sitting within the parent's inventory, so we can't actually claim that inventory. So what we're doing is we're going to add it back to costs of goods sold, and that number is simply taken from there. So if we add this back, costs of goods sold increases, and therefore we're going to have a smaller gross profit due to that. So we're taking out the gross profit, we're backing that out related to the ending inventory. And now you might be wondering why the sales are in here, and that's something that's always stumped me. But if we simply take this equation right here, which I rewrote right there, and we rearrange it ever so slightly right there, we got cost of goods sold, negative cost of goods sold, because it's negative right here, equals gross margin minus sales. So that's essentially what we're doing right here. We're trying to figure out the cost of goods sold value by finding the difference between gross margin and sales. And we're doing this because the sub is selling them at cost to the parent. So we're figuring out the amount at cost, and then we're consolidating that. Then we get our gross profit, and over here we simply add together the parents and the subs values from the income statements provided. And then now we got to figure out what's going on in income tax expense. So what I like is if you get this line on a test or a midterm, this one's pretty intuitive. So we already discussed that if we're realizing this gain in beginning inventory, which is 12, so we take the corresponding tax amount right here, and if we're making a gain, if we're making more profit, then our income tax expense is going to be greater because we're going to have more income before tax to tax. And we're doing the same thing with the ending inventory. So since we're taking out that ending inventory, our cost of goods sold is increasing. We're going to have smaller gross profit. We're going to have smaller income before tax, and therefore we're going to be subtracting out the related income tax related to this 36 right here. And then we simply add together. We make a summation of the two values that the sub and the parent had on their income statements for income tax expense. And then we should get $940.8. So that's part A. Now we're going to move along to the consolidated balance sheet right over here. And we might be jumping up and down a little bit, but that's fine. Okay, so we got our inventory over here as the first asset account. And we simply add together the parents and the sub's inventory. But remember that the sub was selling this inventory at cost for itself, but when it sells it to the parent, it applies the profit margin of $36 or 30% right here. So since the parent had to pay for that, we're going to take that out of their inventory, since they should be recording their inventory at the cost, and now they're consolidating, so we're adjusting that for the cost right here. And like we said, there's also an intercompany balance. The parent had owed the sub $80. They had a payable right here. And as we discussed, the payable, for every payable, there's also a receivable, especially for consolidating. We'll see both sides of that. So we'll take a look at that right now. So we got that 80 right here. We're subtracting that out of accounts receivable. So since we're consolidating, putting the two businesses together, making a combination, then we take that out of accounts receivable and we take that out of accounts payable because they'd be technically owing themselves money. This 150 is simply from our goodwill calculation right here. And then we got a deferred tax asset right here. So since we have an unrealized gain right here in our income statement, and then we have the corresponding tax amount, which is 7.2. But the sub, as an entity on its own, non-consolidated, has actually paid these taxes already. So if we consolidate and we want to reflect what profits we've actually made, then we're also going to have to take out that tax amount right here. But we want to reflect that the tax has been paid. So a nice way to think about this is just go back to the definition of an asset. And an asset is a current resource resulting from a past event that has future economic benefit. So since we've already paid that, we certainly do have the future economic benefit, and it's also resulted from a past event, and it's basically prepaid taxes. So this will show up over here as 7.2. All right, so now moving down to the liabilities and owner's equity, right over here. So like we discussed, that 80 is taken out, and common shares remains the same. And then we have retained earnings and non-controlling interest. And this is actually part of Part C. So when you write the midterm, you probably want to leave that blank right off the top. All right, so moving down to Part C. So in Part C over here, we're going to calculate consolidated retained earnings first. So the parent from the balance sheet provided to us on the midterm in question 2, it had retained earnings at year end of $300, and the sub had the same amount. So now we have to adjust for the increase in retained earnings that the sub had from its acquisition right here to the current date right now, so year end. So we subtract the $250 from the $300, and we have a $50 increase in since the acquisition. Now, as we discussed, inventory is a current asset, and it has to be more than a year for that inventory to leave the consolidated entity and to actually record that as profit or to have a realized gain on that inventory. So basically, since the ending inventory over here, it hasn't been a year, so we're going to take that out since it's unrealized gain. And we're simply doing that because our income after gets put over into retained earnings. So we assume that the income is already reflected in the sub's retained earnings, and we're taking it out. So that unrealized gain that we got from over here, and it's after tax, of course, because the net income is after tax. And then once we take that out, we subtract that, we get an adjusted retained earnings for the sub of $21.2. And we want to figure out what the parent's portion of that retained earnings is. And it's simply the portion that they bought. So we multiply that by 80%, and we receive $16.96. And that'll increase the consolidated retained earnings. So we just add that to the original $300 that the parent had, and we get $316.96 of ending consolidated retained earnings. So we could just take this amount and put it right on our balance sheet right there. Alrighty, so now we're going to move to non-controlling interest. And right over here, we take the sub's net assets. And we could also use the sub's shareholders' equity like we did, like I mentioned in Goodwill, like I like to do. And there's simply less accounts to add up. So that's amounting to $400. And then we want to add back the unamortized acquisition differential. And the reason why we want to add that back is because the sub on its own books isn't amortizing the fair value excess. So if they're not amortizing the fair value excess, then none of that is going to be reflected in the non-controlling interest when we're using the net assets. So what we're trying to do right now is we're trying to recognize that there is a fair value excess, which was basically the premium paid, the goodwill, and we add that back in right over here of 150. So recall, goodwill 150, and we add that back in over here. And we also had that unrealized gain that we dealt with up here, and we've been taking it out along the way, even in our balance sheet. So we take that. So we take that out over here. We back that out of non-controlling interest because we haven't realized that. Once again, remember, current asset hasn't been more than a year. So that 28.8, which is taken from up here, post-tax, of course, and then we get a value of $521 and $521.2. And we got to figure out what the non-controlling interest portion is. So we simply multiply it by 20%, and we get a non-controlling interest at the year end of $104.2. And if we plug that into our income statement, our balance sheet, then that should all balance right there. Excellent. So that was question 2. We're going to be moving on to question number 3 now. Of course, if you did use the 25% gross margin, feel free to download this Excel spreadsheet and take a look at how that would turn out with the 25%. All right, so now we're going to go through question number 3. And question number 3 was another one of those big ticket questions that was worth a whole lot of marks. So most of them, the marks were adjusted for the midterm, and one of the tricks that a lot of people didn't get was in the impairment of goodwill, which we'll discuss in a moment. But first, we're going to start from the goodwill calculation. So we had an amount of 180 as the purchase price for 60%. And to get the implied value at 100%, we simply divided 180 by 60% or 0.6 to get 300. Simple enough. And like I mentioned in question number 2, I like to use shareholders' equity to get the carrying value of the sub's net assets. So that's exactly what's going on over here. We got 120 over here, and we just subtract that out to get our acquisition differential. So our acquisition differential of 180. And now we need to make appropriate adjustments for the fair value excess for the sub. So the following items, equipment, inventory, and the patent, were adjusted as their fair value was increased to 20, 30, and 50, adding up to 100. And we got to subtract that out from our acquisition differential, leaving us with goodwill of 80, right over here, $80. So now that we got our goodwill, we could discuss our acquisition differential amortization table. I'm going to start off with equipment over here, which has a useful life of 10 years. So what we want to do here, since it's got a fair value excess of 20, we want to amortize that 20 years over the useful life of the equipment. So right over here, we're dividing that equipment by the fair value excess by 10, giving us $2 annually of amortization. So in 2001, 2, 3, and 4, we got $2 adding up to 8, and then we got total amortization at the end of year 2004 of $8. And if we want to figure out the unamortized amount, we simply subtract that $8 from the fair value excess when we purchased it. And that'll give us an unamortized fair value excess of our equipment of $12 right here. So now we're going to discuss our inventory, and we spent a while discussing our inventory in question number 2 and how it's a current asset. So since it's a current asset, it technically only remains on our books within a year because inventory is sold off to, well, clients, customers. So the assumption is right over here that we sold it. So this is a perfect example of that. It's useful, its useful life is 1 year. We sell it out, 2001. Right here, first year, and it goes right on out. So that was easy. Now we're going to discuss the patent. Very similar to what we did with the equipment. Simply take that the fair value excess of 50, found right over here, and divide that by its useful life, giving us a $10 amortization for the patent annually. Over the 4 years, from 2001 to 4, it has total amortization of 40. Subtracting that from its original fair value excess gives you an unamortized amount of $10. So now we're going to deal with our goodwill and impairing it. So what we are provided with in the question was the year-end estimated balances. So which I jotted down over here. So 50, 30, 20, 25 from years 2001 to 2004. So what we simply want to do is we got our $80 balance over here of our goodwill. And then since we got a year-end balance of 50 as the estimate, anything that happens in between is the impairment. So we got our impairment value over here. And then since this is in 2001, we put that down right there. Simple enough. And we could use this year-end balance as the open-end balance the following year, like that. And it just sort of follows suit. So that all works out until we get down to 2004. Then this happens. We receive a gain. So we appraise our goodwill instead of impairing it. And unfortunately, that's not allowed. We're not allowed to increase the value of our goodwill. So no appraising the goodwill, only impairing the goodwill. So instead of putting a gain down there, we just leave it blank. We put it down as 0. And if there's a gain in the following year, same thing would happen. So the 2004 goodwill impairment, there was none. And our total impairment at the year end 2004, simply adding these up, gives us 60. If we subtract that from our goodwill acquisition, we have unamortized goodwill or unimpaired goodwill of $20 right there. And this was where a lot of people lost that mark, and that's why it was removed, and that's why the midterm is now out of 43. So since a lot of people didn't quite get this, I'm gonna move over to a version where we actually did recognize that gain over here. So we got that gain over here, leaving us total amortized amount of 55 and unamortized amount of 25 goodwill. So not unamortized, unimpaired rather. All right, so now we're going to move along to part B, and we're going to discuss how we calculate our consolidated retained earnings as well as our non-controlling interest. We're going to start with consolidated retained earnings. So our consolidated retained earnings from the parent, pulled right from the question, is 300 right here. And the same thing for the sub right here, 200. So what we want to do over here is we want to take out the retained earnings at acquisition to find the difference, so how much it increased by. So 200 minus the 80 retained earnings at the acquisition gives us an increase of 120 right there since acquisition. All right, and now we have to take out our amortized acquisition differential. So remember, the amortization hits the income statement. So if it hits the income statement, it shows up as an expense. So since it shows up as an expense, and we haven't been expensing this on a regular basis, and we're consolidating right now, we have to recognize that expense on in retained earnings, since the income comes over to retained earnings. So we're just going to reflect that here by subtracting from our retained earnings. So that we're taking our total amortization at year-end 2004 and subtracting it out right there, and that gives us an adjusted retained earnings of 13. So we now have a negative retained earnings of $13, and we got to figure out the parent's portion of ownership, which is 60%. Multiply that 60% gives us $7.8, and we simply add that negative 7.8 to the 300 at year end of the non-consolidated parent's retained earnings. And then we get our consolidated retained earnings, which is $292.2 of consolidated retained earnings. There it is. All right, so now we're going to discuss our non-controlling interest at December 31st, 2004. So we want to grab the subs and net assets over here. And you could either do that by calculating out the net assets, because we're provided the December 31st, 2004 balance sheet, or we could just take the shareholders' equity. So that'll amount to 240. Now, then we want to add in our unamortized acquisition differential. So the reason we're doing this is because the sub is on the balance sheet is recorded as though nothing had happened, so it hasn't been appraised at fair value. So none of these amounts have actually gone up the fair value over here. So these aren't recognized in there. But what we're going to be doing is we're going to be recognizing that amortization did happen, but from sort of a back end. So we add the unamortized amount right here. So this is the fair value excess that's left to add. So we add that in, and we get 287 of the subs and net assets at fair market value. So we're just simply adjusting it to fair market value after it's been amortized for since 2001 to 2004, so since acquisition. And now we need to multiply it by the non-controlling interest ownership portion, which is 40%, and we get non-controlling interest of $114.8. There it is right there. So that's it for question 3. We're going to move along to question number 4. So question number 4 was all about parent company extension theory. And personally, I was not prepared for this question. I made some stuff up, got some marks, and that's why this little note down here, because we could get it mathematically several ways. I like that. But I wasn't too fortunate on this question. So it's good that I'm going over it now. So what we're used to doing, we're going to recap first in entity theory, is picking up both parts right here. So the carrying amount of the subs net assets for parent and the non-controlling interest, the fair value excess, and the goodwill over here. But the main difference here is this over here, this little darker square of the non-controlling interest part of goodwill. We don't pick that up in parent company extension theory. So we're gonna see how this plays out in this problem over here. So we're gonna do acquisition differential first, which is part A, and the price paid is $490. So, and they purchased this at 70%. So we're not going to find the implied value, which is 100%, or this entire block right here. We're just focusing on this. So the price paid, and then we got to get the carrying amount of net assets. So we add together the assets and we subtract out the long-term debt. So we get the net assets, making sure to leave any goodwill that we're buying from the sub out, giving us a total carrying amount of 450. So at this point, this would be both of these blocks right there. So the carrying amount of the non-controlling interest and the controlling interest, which would be the parent. But we're only looking for this right here. So we're going to multiply that at the parent's portion of acquisition differential, so 70%, will give us 315. And if we subtract that from our purchase price, we'll get the acquisition differential using parent company extension theory right here. All right, so I'm now moving along to goodwill. So we already have our acquisition differential over here, so just bring that down over there. And we get our fair value excess. So John made it nice and easy over here in that we only had one item, the land, that had a fair value excess of $100 right here. So subtract that 50 carrying amount, the fair market value gives us a fair value excess of 100, and we multiply that by the parent's portion right here. So we're finding that. So the fair value excess that we're finding is right over here. It's the parent's portion. And then we get goodwill by subtracting that from this, what we calculated over here, giving us this over here, this amount. So that's 105. So in order to figure out our non-controlling interest over here in part C, what we got to do is we got to figure out the fair market value of the firm. So right here, that's why I got that in italics right there. So we add together all of our accounts here, except this one's already at fair market value. So what we do here is we got that added up, that's 550, and we multiply that by the parent's portion, or sorry, the non-controlling interest portion, and that's 165. There we go. And that's the non-controlling interest portion right there. So we're not picking up any of this goodwill, any of that. We're just getting the fair market value and the carrying amount. So this right here. None of the goodwill right there. And that's the main difference. All right, so that's pretty much it for this video, guys. If you guys have any questions about any of the content, leave a comment below. I'll try and weigh in and provide some insight. If not, then I'm sure we could get John to provide some insight on it. And if you found this video helpful and would want to see one for test number 3 and maybe even the final exam, just hit the thumbs up button to let me know. And if I get enough of those thumbs up, I'll make sure to make another video. And thank you for watching.